So this week you're working on chapter 9, which is more budgeting. And so let's just clarify, right? This week in the book, they discuss a planning budget, a flexible budget, and the actual numbers. So just so we're clear, right? The planning budget is what we do beforehand. This is before the period starts, okay? We don't know, that's when we don't really know exactly how many units we've produced or sold, right? The flexible budget is the planning budget. Another term for this is static budget. The flexible budget is just the planning or static budget adjusted for the actual sales level. Okay, so at this point, the flexible budget happens after the period's over, because we have to know what the actual sales level is. And so this is basically what our budget should be, right? These are our revenues and expenses, what they should be based on our actual sales level. And then actual is what our actual revenues and expenses are. So just make sure actual is our actual results. It's not actual budget. Lots of students will want to call that an actual budget, right? And actual is not a budget. Actual is your actual results, right? And then we just compare across, right? If our flexible budget and actual don't agree, those differences are called variances. And if we manage by exception, that means we look at the variances to try to determine what can be fixed or corrected. Okay, so we're going to look at this flexible versus actual on the next tab here. And again, I'm going to use a problem because I think it shows all of the difficult parts of the chapter in this one problem. And so this is from the Foundational 15. This is a problem in the back of your book. And I'm going to use these 3 questions instead of the whole long list of 15 questions that they have, because these pretty much capture everything. So here we have a company that manufactures one product. Its variable overhead is applied to production based on direct labor hours, and its standard cost card per unit, that means per unit of output, is as follows. So they don't tell us what kind of product, so let's just assume that we're back to our chair example. And so this is saying that this standard cost card per chair, we would expect to use these amount of inputs, right? So direct materials, we would plan to use 5 pounds of wood, and we expect the wood to cost $8 per pound. Direct labor per chair, right? We expect to spend 2 hours and we pay the workers $14 an hour. Variable overhead, because it's applied based on direct labor hours, these are going to match, right? We're going to apply overhead 2 hours per unit at a rate of $5 per hour. So we expect our cost to be $78 per unit produced, okay? And then we have other costs down here: advertising, sales, salaries, commissions, shipping expenses, which actually we're not going to deal with in this problem. Okay, so it says the planning budget for March was based on producing and selling 25,000 units, right? So the planning budget is done before the period starts. However, during March, the company actually produced and sold 30,000 units and incurred the following costs. Right, so 30,000 units is my actual production and sales level. Okay, so we incurred the following costs. We purchased 160,000 pounds of raw materials at a cost of $7.50 per pound. All of this material was used in production. Direct laborers worked 55,000 hours at a rate of $15 per hour. Total variable manufacturing overhead for the month was $280,500. And then total advertising and other expenses were as follows. Okay, so what we want to find out is the variances between our costs and our actual costs and our costs, what they should have been based on the actual level of sales and production. So we're going to look at these three different types of variances. So we're going to look at our materials, our direct materials. We're going to look at direct labor, and we're going to look at variable overhead. Okay, so let's start with our materials. Okay. And we want to compare, right, our actual cost of materials to our expected costs, right, what they should have been at the actual level of output. Right, so we produced and sold the same number of units. So we could say at the actual level of output or at the actual level of sales, it's the same in this case. Okay, so my materials costs, right? How do we figure that out, right? Our costs are based on price, right, per unit times the quantity of units, right? That makes sense, right? So I'm going to call this my actual price. And I'm going to multiply that by my actual quantity. Okay, so what was my actual price for materials? If you look around, you can see down here, it says we purchased 160,000 pounds of raw materials at a cost of $7.50 per pound. So just to clarify, this is my actual price per unit, or in this case, per pound, okay? So this should be $7.50, right? And what was the actual quantity? So I just want to clarify, when we're talking about price and quantity here, we're talking about in regard to the materials, not the number of chairs output, okay? So what was the actual quantity of wood used? Well, we purchased 160,000 pounds and all of it was used in production. So this is 160,000 pounds. So our total cost for our materials is 1.2 million. Okay. So we are going to come back to this AP and AQ. And let's come over here and talk about our expected costs. Another term for this that we're going to use is standard costs, right? That's what we expect to spend. And we're going to look at the standard price, what we expect to spend per unit, times the standard quantity just make this a little bit bigger so you can see. Okay, so the expected cost or standard cost, right? The total is going to be made up of the standard price per unit times the standard quantity, right? The amount of direct materials that we expect to use based on the actual level of output. So this right here is what confuses people, okay? But it's based on the actual level of output. So we're going to find the standard price over here on our cost card, right? So our direct materials, we expect to spend $8 per pound. So this is going to be 8. And then the standard quantity. So what amount of materials do we expect to use based on our actual output? So this says for 1 unit of output, we expect to use 5 pounds. But how many units did we produce? We produced 30,000 units. So the expected quantity of wood that we expected to spend is 30,000 units times 5 pounds, right? We expected to use 5 pounds per quantity or per chair produced. So if I multiply those two out, I get that my standard cost, right, should have been 1.2 million. Let me just highlight these because we're going to come back to this. Okay, so my actual costs were 1.2, and my standard cost, what we expected to spend at this level of output, was 1.2. So there's no variance, okay? But we want to dig in a little bit deeper because we can tell right away, right, that our price for the wood was cheaper than we expected, and we actually used more wood than we expected. So we want to find out what amount of variances are as a result of price and quantity. Okay. So we are going to identify our price variance. And first of all, just to sort of look and make sure everything makes sense, right? I'm going to look, right? The actual price I paid was $77.50 per unit, and the standard price, what I expected to spend, was $8 per unit. So is that a favorable or unfavorable difference? You said favorable, right? We spent less per unit than we expected. So the price variance is going to be favorable. Okay. And then in the book, they go through all the algebra to how to get to the formula of what price variance is. I'm just going to explain it really briefly here. Right? Price variance, we want to see how much the price varies. So the formula is going to be, we're going to hold the quantity constant because we're not interested in quantity here. And we're going to let the price change. So we're going to take actual quantity, hold that constant, and then we're going to multiply that by the actual price minus the standard price. Okay, that's the formula for price variance. And so if I do the math, right, I get actual quantity times the difference between the actual price and the standard price. Whoops, did not like that. Try this again. Oh. There we go. Right, real world Excel problems here. Okay, so we get a price variance of 80,000. This came out negative just based on the way the formula is, but we already determined that the price variance is favorable. Okay. And the quantity variance, is the quantity variance favorable or unfavorable? Right? We spent actually 160,000 pounds of wood, and we expected to spend 150,000. So the quantity variance is going to be unfavorable. Okay. The formula here is, right, it's the quantity variance. So we're going to let the quantity vary, and we're going to hold the price constant. So in this case, it's going to be standard price times actual quantity minus the standard quantity. That's the definition for quantity variance. And so if I plug in the numbers, right, it shouldn't be surprising that I get 80,000, right? Because the sum of these two variances should equal the overall variance, and we already determined that there's 0 overall variance. All right, so our price variance was 80,000 favorable, and our quantity variance was 80,000 unfavorable. So what is the story behind this? Why could that be the case? Right, one rationale or one reason behind this could be that, right, we bought a cheaper quantity or quality of good, right, which is why we spent less, but then we ended up having to use more, right? We ended up having to use 150,000 pounds. We ended up having to use 160,000 pounds instead of 150,000 pounds because the wood was chipping or breaking, okay? Okay, so we're going to follow this same process for both the labor and the overhead variances as well. So this is the materials variance. We're going to move on and see what our labor costs look like. And we're going to follow the same format. So again, the price variance and the quantity variance, right, are all going to be the same. So I'm just going to copy those down here. And then the key is to find these four variables. Okay. And then just to point something out, in this case, it's always price and quantity, but with regard to labor, instead of calling it price, they're going to call it rate. But it's the same thing, right? And quantity, the quantity of labor used, I'm going to call this an efficiency variance. It's the same as the quantity variance. Okay, so can we find our actual price of labor per unit? So down here, right, direct laborers worked 55,000 hours, okay? So with regard to labor, right, we're talking about labor hours. And so that tells me my actual quantity used is 55,000 hours. And the rate, or the price per unit, right, per hour is $15 per hour. So my total labor cost is the 15 per hour times 55,000 hours. So I get 825. Okay. How about with regard to our standard cost? So if I come up here, right, my direct labor, my standard price per hour, I expected to spend 14 per hour. So I'm going to plug that in. And then again, this is where people get confused. Remember, we're looking for the standard quantity of hours based on the actual level of production. So we expect to spend 2 hours, right, per unit produced. So 30,000 units. So we expected to spend 2 hours times 30,000 units. So we expected to spend 60,000 hours. Okay, and so our total expected labor cost was $840. So what is our overall labor variance, right? It's the 825, our actual, minus our 840, what we expected. So our overall variance is 15,000. Is that favorable or unfavorable? Right, it should be favorable, right? Because we spent less than we expected. Pull these out. Okay, so let's break that down further into the price and the quantity variance. So the price variance, is that favorable or unfavorable? Right, you should get unfavorable, right? We spent 15 per hour and we expected to spend 14 per hour. So this number is going to be unfavorable. And then how about the number of hours that it took our labor to make the 30,000 units, right? We expected to spend 60,000 hours based on our actual output, and our laborers only spent 55,000 hours. So that's a favorable variance. Okay, so let's plug in the numbers. So we have our actual quantity times our actual price minus our standard price. That gives me 55,000 unfavorable. And then my quantity variance is my standard price times my actual quantity minus my standard quantity. Right, and that's 70,000 favorable. Right, and notice if we net these, right, 70 and 55 going in opposite directions, we get 15,000 favorable, and that's what our overall labor variance is. Okay, so we did the math right. So what is the story behind this? Right, if our rate or price variance is unfavorable, meaning that we spent more per hour on our labor, and our quantity or efficiency variance is favorable, what does that mean? Right? It could be that we paid for higher skilled labor, so we paid more per hour, and therefore they got the work done quicker, right? So we paid more per hour, which gave us an unfavorable variance, but they worked faster and better, and so we have a favorable efficiency variance, right? And overall, that seemed to make a difference because we end up with an overall favorable labor variance. Okay. And then finally, we get to variable overhead. Okay. And we are going to do the exact same thing. So I'm just going to copy all of this. Knowing that I have to change some numbers here, right? Okay, so again, we want the price and quantity variance. And where it gets a little confusing here is overhead, right? It says up here, overhead is applied to production based on direct labor hours. And the standard cost card is as follows. Okay, so our quantity is actually based on our labor hours. So this 55,000 and this 60,000 are going to stay the same. What's going to differ is the price or the rate at which we apply overhead. So our standard price, if we look up here, variable overhead, right, 2 hours, and we expect to allocate it at $5 per hour. So our standard price is going to be 5. Okay. Can we figure out our actual price? We can, right? Because this is our total variable manufacturing overhead for the month was $280,500. So this means the price at which we allocate overhead times the quantity gave us $280,500. So in this case, we have to solve backwards for our actual price per unit. So we take the 280, divide by the 55. Okay. Okay, and then everything else is done for us already. So our, except this shouldn't be labor variance, this should be our overall variable overhead variance, right, is the 280,500 minus the 300,000 is 19,500, right? And we spent less than we anticipated, so the variance is favorable. If we follow the same formula, right, and we can tell right away again that we allocated overhead at the rate of 510. We expected to allocate it at the rate of 5, and so that's unfavorable. And then because overhead is allocated based on direct labor hours, right, we know that we spent less direct labor hours than we anticipated, and so this variance is favorable. So hopefully that is pretty straightforward. Again, I just want to point out that this is where people get confused. The standard quantity of materials, labor, and overhead is always based on the actual level of output. Okay. There's one more thing. There's one more little glitch. So if I just move this all down. So in the case of materials, right, the problem told us that we purchased 160,000 pounds of raw materials at a cost of $750. All of this material was used in production. Well, right, what happens if not all of the units of raw materials purchased were used in production? Okay, so for example, let's say we purchased 170,000 pounds at $750 per pound, and we used 160,000 pounds in production. okay? So if we purchased a certain amount and we only used a lesser amount, we handle these variances a little bit differently. So the difference in calculation is going to be in the price variance. So we're still going to use this formula with one exception, right? We want the price variance to reflect the difference in price that we paid for all goods, not just the ones that we used, okay? So your AQ in this case is going to be equal to all of the goods so you want the AQ to equal all of the units of direct materials purchased, not just those used. So then my formula here would be, what is my AQ? In this case, my actual quantity purchased is 170,000 pounds. And then the rest is going to be the same, right? The 750 minus the 750 from up here minus the 8 from up here. Okay. So that's going to give me a slightly different price variance. Right now it's 85,000 favorable. And therefore, this variance plus this variance are not going to agree to the overall variance, okay? And that's okay. So just remember this as you're working on the homework, right? If the direct material used in production do not equal the direct materials purchased, for your price variance, you use the quantity of all of the direct materials purchased. Okay, if I didn't touch on a question that you have, let me know. Otherwise, good luck on chapter 9.